Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. The calm of last week's trade has given way to the global headlines and various asset class reactions therein. So the questions swirling through the geopolitical gyrations in recent days have led to two curious reactions in the bond trade and also for the US dollar. Both have been haven trades, as we know, for decades, and both are getting shaken as the global trade structures shift beneath our feet a bit here. However, investors' money flows, and flow it has to other areas of the world when valued at lower prices, and also back into U.S. asset classes when the price is right. Helping us to digest these new moves via his weekly charts and graphs for you is Fidelity Director of Global Macro, Jurrien Timmer. Welcome, Jurrien. Great to see you. How are you?
Good morning, Pamela. You're my last stop before I head over to Europe for a 2-week client roadshow. So we'll make this one count.
Okay, we'll make this one count, and we thank you for it. I mean, you're literally going to be in a different city, I think, pretty much every day for the next 2 weeks. Is that
Yeah,
it?
I'm flying to Zurich this afternoon. I'll be there for a couple of days, then London, then Paris, then Frankfurt, then Hamburg, then Amsterdam, and then back in time for the 4th of July here in the U.S. So.
Okay, and maybe a little bit of rest. Okay, well, we're delighted to have you here with us. That was quite a weekend. As you say in some recent notes, it was actually kind of a calmer week last week, and people did digest a little bit. And then?
Yes, until Friday, basically nothing was going on anywhere. Another inside week, as we call it. And then, of course, the headlines have to come on a Friday, right, when we're left hanging all weekend long. And this is actually where not to digress, but this is where Bitcoin actually comes in really handy, because Bitcoin trades 24/7. And it is a good proxy for risk appetites. And so over the weekend, Bitcoin did very little. And while the equity futures were closed, kind of gave a hint that the world was not falling apart. But obviously, whenever you see headlines like we saw on Friday, you always start wondering or fearing the worst case scenario. But at the same time, today's recovery, which about equally offsets Friday's loss, is another reminder that we should not chase headlines. If you have a portfolio that is positioned for downside risk, then just trust that process and stick with it, as hard as that can be to do. So that's kind of the lesson here. And it looks like from the headlines that Iran is sort of waving the white flag a little bit, and that obviously would be good news for many investors in terms of not getting that escalation of increasingly more dangerous, weapons flying around. And so hopefully that's where we are, and I think that's what the market is reading. But to your point, and we can go to slide 1 here. There's an old adage from us technical analysts that what doesn't happen sometimes tells you more than what does happen. And so on Friday was a classic risk-off day, of course, geopolitical headlines, we know the story, and you would expect certain things to happen. You would expect stocks to go down, which they did. You would expect gold to go up, which it did. And you would expect the dollar to be bid and for bond yields to decline, because those are safe havens that when investors go risk off, that's where in the past couple of decades they would hide. And the last two things did not happen. So this is a chart of the 10-year yield, daily chart, and below that the dollar index. And you can see that the bond yield has been in a range now for several months.
Mm-hmm. I was going to say, this is not a weekend story. Like, this is a story that has been, yes.
Yeah, and it's so last Friday was the second time this year where what should have happened didn't happen. The first one was, of course, after the so-called Liberation Day, which is still an ironic term, but let's not go there. Mm-hmm. And so, bond yield, you would think risk off, recession risk, or just stress in the financial system, the risk-free asset of the world, treasury bonds, would get bid, and the dollar would get bid as well. And it didn't happen then, and it didn't happen on Friday. And so by extension, we don't really have the opposite of that today, because nothing happened in the first place. But to me, that is a tell that the world order really is changing just ever so slightly, because these things normally would behave differently, and so it's a hint at a new world order where maybe gold has become the new long bond, and maybe the dollar is not as hegemonic as it has been in the past.
Right. It's fascinating how this all works. Now, with that said, we sort of mentioned at the outset that investors' money will flow elsewhere. And we know throughout the year it has done exactly that. There's been an international trade that's been fascinating to watch on the equity side of things. Investors have moved money based on certain things that they're seeing and the Liberation Day trade, but even before that. What do we need to sort of know about whether we're going to see this market melt up, because there is an argument for that, this wall of worry, or are we sort of stuck in what I think you were telling us a couple of weeks ago, a bit more of a trading range, which isn't necessarily stuck. That isn't necessarily a good word for it, but
Yeah.
there's a limit ultimately.
Yeah, I think it's the latter. And just before I go there, you raised just an interesting point about capital flows, that that dollar hegemony may not be as hegemonic anymore. That doesn't mean that the dollar and U.S. assets get like punished. It's just, to me, it means that it's a more level playing field. That what was a one-way ticket over the past 10 years now really is more of a broader menu, a more level playing field, where euro denominated assets or yen denominated assets or emerging markets, um, they may not be better than the US, but they have an equal chance now, and it really becomes a level playing field. So that's kind of how I think of it. And it really is a much broader menu, which as a chef, you always want to see a broader menu. So, but let's go unpack that. And so I'm kind of in the trading range camp. So if we go to slide 4, this is the chart I've been showing for the past so many weeks. We continue to track the best case scenario in terms of what happens to the S&P after it has fallen 20%. And that pink line is the 2018 Powell pivot. And we continue to track that. And that would indicate, maybe not a melt up, but certainly a continuation of the gains that we've seen since late April. But I'm not so sure that that will continue. If we go to slide 3, this is the same analog study, but now measuring it from the high, which was February 19th, to where we are now. So as you can see, we fell 21%. We recovered almost all of it. So we're within like 1% of the highs.
Amazing.
And other than just a couple of times in history, has the market been at new highs this quickly? 1998 was an example, very soft landing, 2018. But in most cases, this recovery has happened so fast, even though the world's problems have hardly all been solved, right? I mean,
Right.
the 90-day cooling off period is expiring in July. I think Scott Besson was hinting that it might be extended, which I think would make a lot of sense. But still, you have earnings growth now slowing. The PE's back to the highs of 21, 22. So not that much has changed. And so I'm skeptical. I think the market is on okay footing here, but I like to think of it as the V becoming an M, where it really starts to look a little bit more like 2015, which is the light blue line there. And so I'm not convinced that we're off to the races in some sort of melt up. And if I could just and actually let's add slide 2 here. This is a new chart just to demonstrate how quickly we went from the left tail to the right tail. So if you think about a bell curve distribution of returns, in this case, this is 4-week price changes in the S&P going back 100 years. You obviously, most of the time, you're somewhere in the middle, and then you have the left tail when the market prices in a really bad outcome, and then you have a right tail where prices in a good outcome. And we were at the left tail on the week of April 4th, and we went from that left tail to the right tail 3 weeks later. And so it really was as if nothing ever happened. If you took a 6-week nap, you would have woken up to the exact same levels as before. But obviously, we know that a lot did happen, and so I don't think this is the time to bet big on the upside because we are pricing in a right tail, and I'm not sure that a right tail scenario is really warranted, especially with all the tariff stuff hanging over us and the conversation earlier about the dollar and
Right.
bonds and capital flows. So, and then I'll just throw one more chart in there, slide 6, where it's just a daily chart of the S&P. And again, we're back at the highs. You see there that big V-shaped recovery. But look at the quality of the rally. It's really not that great. So the Mag 7,
That's
of course,
interesting.
has been instrumental, and today they're leading again. But if you look at the breadth numbers in the bottom, we have less than 50% of stocks above their 20-day moving average. That may very well change today with the uptick in the market. And then on the top, you see some divergences there against breadth and kind of looks like a rising wedge. So this is not a chart that gets me really excited. So I'm going to err on the side of tempering my enthusiasm a little bit, and so that's why I think a range makes sense with the upper bound limited by what could happen to bond yields if they go above 4.5, and
Hmm.
we've been kind of sitting there. We're at 440 or so today. We've been sitting there for a number of months now, and I think the bottom, of course, boundary is set by the fact that um, that the administration did respond to market weakness back in April. So I think those are kind of the boundaries here of what may be a trading range for U.S. stocks, while the rest of the world actually does better.
It's fascinating if you take a look at. I mean, often investors and those advising them will say, "Listen, you can't time the market, and you can't know when to get back in after even a 20% fall off there." And so it's better to stay in, try not to time it. So all that said, it makes you wonder what you do at this point, because I guess, what's the danger of something coming back quite so quickly? Because often the advice will be, well, it will come back quickly, and so you don't want to bounce out and then have to
Yeah.
figure out when you bounce back in. So what's wrong with the fact that it was super quick, I guess?
There's nothing wrong with it, and actually, the quicker the recovery happens, the better it is, obviously, because we tend to not remember the quick ones as much as the slow ones, right? So 2022, that was a 9-month or 10-month
Grind.
actually
Mm.
bear market, 28%, and it just kind of dragged on, right? We're always worried about the Fed and inflation. And so you feel those a lot more than the really quick ones. That's why the crash of 87, even though that was also 28%, but in one day, it recovered not overnight the way this one has, but it did recover relatively quickly. And few people think back, with trauma to that day. Maybe that day there was trauma, but not to people's investment portfolios over the long term. So I do think the time element is a very important part of what makes a bear market a bear market. And that's why, even though we fell 21%, it may not even be a bear market. If the market really does make sustained new highs here, then it was a bear scare, or a
Right.
bear adjacent, as Denise Chisholm likes to
Yes.
say. But it probably wasn't more, and it would be similar to what we had in 2018, which was equally fast and an equally fast recovery, as we showed earlier in the charts. But to your question about portfolio, the best days often come after the worst days. We always tell our customers that here in the US. And the key is to have a portfolio that you can live with, that is relatively all weather. It's never going to be completely all weather, because in order for that to happen, you would need to have so little risk in the portfolio that your returns don't compound to the degree that they need to. But we can actually kind of, actually, I don't have the chart this week, but it's, it's kind of some derivative of that 60/40, right? And we've had this conversation, I think it was last week, where even if the 60 provides less upside, less beta than it has in the past, which is my sense, You can tinker with the 60 by having less in the US and more in EFA, and I'll show you the EFA earnings chart in a moment. And then in the 40, if bonds are going to break above 4.5, then maybe that 40 becomes a 20, and then the other 20, actually, and we can go to slide 18 here, maybe that other 20 is other stuff, right? Like
Yes.
liquid
This
alts
is a
and
great
gold
one.
and
Mhm.
maybe some Bitcoin. And so to me, this is like a little sanity check that I do because um, my sense is that the 60 is okay, and we have so much low-hanging fruit in terms of the stuff that didn't participate over the last 10, 15 years, so anything non-US. So there's probably still beta to be had, maybe not so much in the US, but elsewhere. And then on the 40 side, asset classes that are uncorrelated to both stocks and bonds, and that also have high Sharpe ratios, that's what we want, right? And you can see them in blue there, that there are things we can own in a 60-40 that may be a 60-30-10 or a 60-20-20, where you have stuff that works well. And like, for instance, gold on Friday, did very well. And we've only given back a part of that today. And so there are ways to get this done, but then it's a matter of just having conviction and trust in that process, and not change it every time the headline changes, even though the reality does change from time to time, and we need to adapt to that.
Connected to the bond story and also to sort of the haven story, of course, is gold ultimately, but it goes in some of the things you're discussing to a liquidity story, and you've talked about this before. Awful lot of liquidity sloshing around the world. There are fiscal impulses all over the place. M2 money supply is high. Um, just talk a little bit about that, the inflation piece, and therefore gold, basically.
Yeah, it's a great, great question. So let's go to slide 12. So gold is very interesting here. I really do think it's the new long bond. So if you go back, if you look at an efficient frontier chart uh, prior to 2022, when rates finally reset after many, many years of very low levels, before then, the long treasury bond would have a 6% return, a 12% vol, and a negative correlation to the S&P. So that was like the perfect hedge, right? That's where the whole risk parity era came from. Because something that has a good return and a negative correlation, like what's better than that? Since that time, gold has taken that exact spot away from long bonds, which now have a negative return and a positive correlation. And gold has a positive return and not a negative correlation, but a non-correlation, basically. And so to me, gold has become the new standard for safety, if you will. It is hard money. You can see in this chart, the red line is the global money supply, and gold can be many things at many times, including a hedge against price inflation or obviously geopolitics, but or negative real rates, but it also is a hedge against monetary inflation, which we're seeing right now. Global money supply growing at almost 9% now. But in the past, gold would bounce on days like Friday, and then it would just give it all back the next day because gold was not a strategic asset. It was kind of lost. And for instance, in a financial crisis in '08, gold was the last one standing. But then at the end of the day, when the margin calls came, anything that was a source of liquidity would be sold, including gold. And it was just dollars that were the champion. And that seems to now be flipped around,
Yeah.
where the dollar is not as secure. And again, I'm not saying the dollar is going to go down a lot, but it has lost its status a little bit. And gold, which has been accumulated by many central banks, especially China and Russia and others, seems to be the strategic reserve, or seems to be a more competitive strategic reserve asset than it has been in a long time. So maybe gold is no longer that source of liquidity, but becomes the demand for liquidity as investors maybe sell their dollars and buy gold. So gold has had a hell of a run, of course, but I still think that in this new era of fiscal dominance and maybe geopolitically a slightly different world order than we're used to, where the world is getting de-dollarized. Gold and maybe at certain times, Bitcoin as well, when its split personality is on the store of value side, not on the Nasdaq side, can join forces. And actually, gold and Bitcoin. If we go to slide 16 for a moment. Gold and Bitcoin are now kind of moving in the same direction. You look at the Sharpe ratios below, which is the risk-adjusted return. They've converged, and gold and Bitcoin have been. I liken them as different players on the same team, but players that have not been on the field at the same time. So
That's
they take
interesting.
turns, and now it looks like they are on the field at the same time, and that's certainly an interesting change.
Very Ted Lasso. I like that. Yeah, I like that. How much does the best case scenario and this person is not being specific to exactly what that is, dependent on the continuation of the tariff pause? Yeah, it's an interesting question.
I think very much so.
Yeah.
So we have the 90-day reprieve at first from the all reciprocal tariffs, and then of course with the China story. From what I can gather, that reprieve might be extended, but it hasn't gone away, right? And so it that speaks to the earnings and the margin story and potentially the inflation story. And actually, let's bring up slide 8 here. So if all we got was the 10% tariff on most countries, I think the markets are okay with that. You can see the earnings squiggles for the S&P getting sort of marked down, derated, if you will, because obviously 10% tariffs, they're going to be paid by someone, whether it's the companies through lower margins or consumers through higher prices, or maybe a combination of the two. And so those numbers were marked down in April and May, which makes sense. And now they're actually stabilizing and maybe even coming up a little bit, because investors are sort of unpricing the worst case scenario. And so if the story resurfaces in terms of tariffs and reciprocal tariffs and things like that, then you could see renewed downward pressure on earnings. But either way, it's hard to see the earnings estimates go all the way back up to where they were. And at the same time, it's not like we're trading at a 16 PE. We're trading at a 21, 22 times PE. And so the fundamental story is okay, but it's not as good as it was in 2024. And again, that valuation headwind, if that's what we're getting, I think will limit the upside. But if we go from this chart to slide 10, sorry, this is where it gets interesting. And again, talking about the 60 side of the 60-40 and the loss of the US exceptionalism, or a return to a more level playing field, you can see that playing out in real time. So this is the black line is the ratio of S&P 500 to MSCI EFA, so non-US developed. The blue squiggles are the S&P earnings estimates by year, and the pink ones are the EFA estimates. And you can see a clear divergence, or convergence there, I should say, where the US estimates are coming down, holding steady now, but the EFA earnings estimates are clearly improving. And that is the catalyst that we're waiting for, in some cases, a number of years, when we were looking at that mean reversion between US and non-US. The valuation side isn't enough. You need a catalyst in terms of the fundamentals, and it certainly looks to me like that one is underway now. So there's a lot more low-hanging fruit around the world now than there was.
Yes, and as you say, there's a catalyst to really look at it and look for it. One of the big questions with that is whether there are still legs to run there and to go, because it is coming up on the EFA earnings estimate side so quickly. Can it be sustained, or do you need to go and look at Brazil? What else can it do from here?
Well, it's interesting. So the MSCI ACWI ex-US index made a new all-time high last month for the first time since 2007. I mean, that tells you something, right?
Decades, yeah.
Yeah, decades, almost 20 years. The MSCI emerging markets ex-China index last year was rocketing higher, including China. So the overall EM index is nowhere near the old highs, but things are definitely stirring. And even if we don't get sort of the massive beta on the non-US side, I think there is alpha to be harvested, right? So Europe is more of a value play. I don't know many PMs who are super excited about the earnings growth potential in Europe or even like in China. But if you have value stocks that maybe don't go up a lot, but they're cheap and they pay healthy dividend yields, in a world where the US provides maybe less beta than it has in the past, if the secular wave is cresting, that's not a bad outcome, right? And so it means lowering our expectations that we're not going to get those 15 to 20% returns, but getting 7 to 12 in that pocket of the world, which is a big pocket that has been left behind, and then generating some alpha on top of that by maybe being underweight fixed income and having these other diversifiers in place. I mean, that's not a terrible outcome either.
No. Talking about the weighting of the Mag 7 in the S&P, obviously the valuations came down significantly. We've seen that trade come back in. They're not as expensive as they were. But just talk a little bit about the S&P, the relative, insanely overweight place that they took for a long, long time, and kind of where it goes from this point.
Yeah, so let's go to slide 7. And you're right. So the Mag 7 have driven the recovery rally. You can see there in the top panel that they're also still below the old highs, just like the S&P is, but they've definitely have sort of driven the bus in terms of the recovery. And you can see in the bottom, the trailing PE, is only at 33 times earnings only, but 33 times for these stocks that have generated so much free cash flow power and payout ratios, is certainly better than what they have been, even though it's still about a 50% premium to the rest of the market, right, which is trading at about 21. So it's certainly a better story than in the past. When you look at the earnings squiggles, which I don't have this week, they're kind of flatlining though. So there's not a lot of earnings momentum going on. But they're a third of the market, and whatever happens to the Mag 7 is going to happen to the index because they're driving the bus. So exactly. So that is an important consideration. But again, looking at that earlier chart of the daily S&P and looking at the breadth numbers, it is a more narrow market now on the way up, and that's not generally what we want to see.
Just before you fly off to other destinations, and we'll miss you and we wish you well, a final thought on bonds. You talk a little bit about a fork in the road. Are we actually going to see the 10-year just come off a bit from where it is right now? Because there's a 30-year story.
Let's go to slide 13. So bonds are at a fork in the road, the way I look at it, right? I have a bond model, which I've shared many times. It's not sophisticated, but it's just based on a regression of where the forward curve is. So what the Fed is expected to do, which is to ease moderately from here at some point, and nominal GDP growth trends, labor force growth, demographics, things like that. And the original model is in the pink shading there. And based on what the Fed is expected to do, you can see that the fair value range, if you will, goes from where we are now to about 3% to 4.3%. And we're at 4.4, so we're at the upper end of that range. So all else being equal, I would say, bonds are okay value here because they're probably going to go down in yield. But that is before we adjust for the term premium, because this model, which I've back tested for a long time, but the last 20 years or so has been an era of financial repression until a few years ago. Zero interest rates, quantitative easing. So the model fits for a period in part where the term premium was either zero or negative. And that is not the way term premiums are supposed to work, of course. And so the term premium has now come back up. It's at about 80 basis points or 70 or so. And so if you allow for a return to a more normal term premium, let's say 150 basis points, you get to the yellow shading, and that gets you from 3.2 to 5.5. So we are literally in the middle of those two bands. And it's just a question of whether you think the term premium is going to come back. And my sense is that it is. So to me, bonds don't offer a lot of value here. And you can see again that this beach ball effect, right? Whenever the yields come down because of some geopolitical headline, like a beach ball held underwater, it pops right back up, and that's what we see now time after time. And it tells me that the path of least resistance is probably a little higher than where it's been now.
Okay, so yields come down. Jurrien Timmer, it is fascinating to get your thoughts on all of this. We wish you well, have safe travels, and very grateful for your time. All the very best.
Thank you very much.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.